again, and Jan and I and Rhonda have been fortifying ourselves with copious cups of coffee at the local cafes. So you only had one, that's right. I'm about my third one, believe it or not. But anyway, we'll get ourselves there. So look, it's great to be here. And why don't we start with Karakia, and then I'll make a couple of opening comments, which would be great. You join me in the Karakia, would appreciate that. Te hora, te marino, he whakapapa ponano, te moana, he uari mātato, e te rangi nei, arawa atu, arawa mai, tato i atu, tato kato. May peace be widespread, I said, as the first line of that. That will be good today. I'm not going to say it what's worth. Let's appreciate the fact that we've got a good set of papers, Jan, again. My appreciation to the team, some of whom I'm sure are lined up down the side of the wall. Actually, you already come forward to the table. There's plenty of room, guys. You don't have to sit over there.
Great idea.
It might help Rhonda feel more at peace. Come on up to the table, you guys. There's plenty of room.
Getting them up to table? No?
Seriously, come on up. I do appreciate the work that you guys, these papers, and what it's worth. Yeah, take it. Let's bring the other chairs. Bring the other chairs around, you guys. There's plenty of room. I just want to acknowledge, particularly as we come towards the end of the triennium, how I think over time things have improved in terms of what's coming in front of the committee. So the committee is well informed. We have no reason not to do good work with the good papers that we have. So it's tremendous. Let's have it and to be here. Amy, just so I get this right, we are recording the meeting, correct?
Yes.
And
live streaming.
Pardon?
Live streaming.
You're live streaming as well. Oh, that's brilliant. So if there's any members of the public or other interested parties involved watching, welcome to the meeting as well. Health and safety, you know better than I do, but obviously there's a couple of places to get out, and also you should drop and roll, whatever the right words are, if we have to. Are there any apologies? I hope to have the meeting through time for you to have lunch, at least around about midday, perhaps 12:30, and to conclude the meeting at that point. Pardon? Oh, is Woody an apology now? You said Woody was coming. He's just late. Okay. So my long point is hopefully you folks can stay. So apart from Woody for lateness, is there any other apologies? There being none, I'll put the motion that we sustain Woody's apologies for lateness. Enjoy the second. Thank you, Martin. All those in favour, please say aye. Aye. Those against, carry. Is there any matters coming up on the papers that you need to note your interests? As there was, so that's good. Martin, is there any acknowledgements or tributes we should note today?
Well, I think there is one. So it turns out that round about now is a 45th anniversary of Janice's work for local government. And I think that is pretty spectacular achievement. And I definitely think an acknowledgement is due.
Oh, that's
Yeah.
That's 45 years. Wow.
God,
That's impressive.
that's a lifetime.
Must be.
I think we were talking about local government politics and what you experienced on Saturday. So, so well done. I think seriously, the work, Janice, that I have seen you do here in my little short time has been impressive, Martin. I think you would agree as well. So, and I suspect my fellow committee members would say the same thing. Well done, Janice. And that's great. I haven't had any indications that the public wish to participate. There's no actions arising, and I'm not aware of any urgent business that people need to deal with. So, in essence, the agenda is as we've got it, and in going through it, I don't propose to alter the pattern of the agenda. It seems to me to be relevant to do that. Can we move to the minutes then, please, of our last meeting, which is the 28th of May. Move from chair, we hold them. We've actually got the public excluded minutes, which are relatively brief as well. I'm going to move we treat them as a true and correct record. Do I have a second for these next files? Is there anything in them about accuracy, correctness that you need to know? Much like the meeting I was in. I put it, okay, all those in favour, please say aye.
Aye.
Those against, it's carried. Were there any matters arising from that that we needed to note? There was just one, Amy, and I'm not busting my boiler over this one. On page 4, under 11.2, he said it would be useful at some point to have Aon turn up. This is around our insurance and insurance strategy.
I was planning that for after the new training takes over because we need to get a pointer on strategy. So, yeah.
Yeah. Look, that's fine, because our rollover date's normally 1 November, correct?
Some is 1 July, some 1 November.
Yeah, there's a wee bit of both. Yeah, okay. I have sensed just from my experience elsewhere, well, two things. One is I agree with you entirely. Charlie, we need to look at our strategy. That's the reason for that action being there. But secondly, the environment for insurance placement this year seems relatively normal. So I don't think we're running any greater risk by not seeing Aon now. And the reality of it is, if we have any form of strategy of development, it takes time, is my experience anyway. So if we can perhaps just agree that we'll hold that over to the new year, that makes sense. But it would be logical to have them in early-ish the new year. If I can put it in the triennium, if I can put it that way, because it'll, if we're going to do anything for the following year.
Absolutely offered to do that too.
Yeah, great. Oh, that's good. Oh, well, if we just know that it's next year, so, or sorry, the next triennium, we don't sort of keep trying to bring it up as a bringer. Okay, I think that was probably the only other thing that I needed to know from there. So, Charlie, we will go straight into the substantive reports. The first one, obviously, being your financial reports.
Absolutely. Millie's going to present some of this to you. So please be gentle and she'll ask for any help with questions if needed.
Thank you, Chair. I'd like to point out that this is draft report for June 2025, not the final report. We don't normally present this. Instead, we wait for the annual report. However, we felt we were ready enough to give you the draft reports. Now, at the time of submitting this report, the reserves journals hadn't been done, and for that reason, the balance sheet was omitted. In terms of numbers, there are no significant variances between actuals and budgets to report, except to note that RITS revenue was slightly lower because this is the first time that we did SOOPs and we didn't know how many remissions we'd receive. That's why the RITS revenue is slightly lower. Grants and donations are mainly a timing issue, and contributions variance is due to reduction in developments. Other than that, there is nothing much, and Charlie will talk about RITS debtors and
I will also just point out that there's the over budget of depreciation. Now that was because of a change in useful life that came about when we did the revaluation of our infrastructure. The roading network significantly was the one there that had the useful life shortened. So of course you have to increase your rate of depreciation. And we hadn't budgeted for that, but that is largely a balance sheet activity there. So. Any other questions about the P&L?
Yeah, let's deal with the P&L first. So the first cider, I take your point that it's draft. So and obviously we're going through an audit process. We'll come back to the draft for the preliminary results for the financial year. That's what makes this report significant. So yes, Miles.
Is there a risk this will end up this will affect our year-end cash flow position? And regarding borrowings, etc.
Regarding borrowings, you'll see later on in the report that the capital program is behind.
Yes.
So we haven't actually borrowed to where we were planning to in the annual plan.
So that will get carried forward into the next.
So we have reassessed the capital program as part of the LTP.
Yeah.
Some projects would have actually just dropped off there because realistically they weren't going to happen, and the rest of them would have been retimed into the LTP. So it would be more prudent to look at the LTP borrowings as opposed to the annual plan. I think the annual plan was still carrying over a lot of projects that either timing wise or realistically weren't going to happen, particularly in the water area. Yeah.
Thank you. Thank you, Charlie.
Yeah, sorry, Woody, I'll come back to you too. I was trying to think about what the balance sheet will look like. Obviously, BOS, you won't get the level of debt you anticipated given you haven't carried out the you haven't carried out the capital program as being foreshadowed. We'll get to.
Well, it does show
You're
care.
probably got a bit of cash in the bank as a result as well. So, yeah, although, yeah.
Yeah, the one. There's
I don't, why would there be a cash flow problem coming up?
who's down in the said.
Distributions, yes.
Right.
Contributions specifically is going to be something we'll need to monitor and
Yeah.
is going forward. However, it could also be fair to say that some developers were waiting for the new district plan. So it is possible that now the new district plan is about to be enacted. We may get some more development in the next year or so. So it may pick up to levels prior to that.
Still got a reasonable level of resource getting going through at the moment, haven't you?
And we, for our long-term plan, we don't take the closing balances of the annual plan. We reassess the opening balances completely. So the interest cost in the 25-6 year was based on what we were realistically expecting to have in borrowings, not based on the full annual plan borrowings. We always do that.
The bigger chance.
Thank you. Footy.
Thanks, Bruce. Apologies for being late, bit of a hold up this morning.
We've sustained the mate, so no worries.
Yeah, yeah, yeah.
You were going to.
Yeah, the land transport over budget, 2.2 million. What's the main reason for that, Charlie?
So there was still some emergency works. Now, it might seem like it's been a long time since we had a major storm. We did have the May event last year, but there was still some residual work from Gabrielle and Hale going on in the year. So, yeah.
As far as appreciation and life short for the estimated life of roading infrastructure, is there any particular roading infrastructure that is, or is it the whole?
It's across the board, definitely, yeah.
I was just thinking, your comment there, Woody, whether that would probably be a question of depreciation, but what an accountant would call impairment. Is anything that indicates something has been impaired? Other
We
than
have made one impairment this year.
Yeah,
I'm not sure whether that made it into the draft or not,
Yeah.
which was the bridge that we are about to fix. So, yeah, we had to impair some of the value of that.
yeah, okay. What was the loss on review? That's just the loss on revaluation. That's the current year's movement, correct?
Land and buildings were revalued this year, and of course, the last time they were revalued was at the peak of the market. We hadn't quite anticipated that much of a drop when we did the budget, so.
Yeah, okay. So, I mean, it does.
There's no
It does fit the overall bottom line, doesn't it? But it's
Yeah.
just the balance sheet impact. Okay, visual to sell. Okay, that's useful. Is any other questions folk around the P&L folk would like to raise? We'll come back to the audit of this later on, get to your audit, so that's fine. Okay, well, let's keep going then, Charlie.
So the next thing on there, although we didn't include the balance sheet in full, obviously we know what our bank and our loans are at the end of the year. We don't change those through any journals, so we've got our investments there. It would be fair to say we did have a fair bit of cash at year end. But we have got some significant capital program coming up this year. So we don't borrow until we've run out of cash and cash equivalents. That's how we don't just borrow for the sake of it and leave cash in the account. The main thing that we keep under term deposit these days is the balance of the Payne Farm Trust account. So that term deposit there represents the balance of the reserve for Payne Farm.
Yes, 480 years.
Yeah. Borrowings, as you see, they were lower, so 28.5. And you'll be able to see there that other than 6.7, all of that is currently due for maturity in the year. Now, I'm sure Earl will give some more context in a moment as to why we've kept that on.
Brilliant.
Yeah, why we've kept that on short term for now, and what the strategy going forwards over the next few months as those loans mature. But it would be fair to say that we're not budgeting to pay any of those back. We are looking to roll those into longer term. We do have to bear in mind the transition of waters in that plan. So whereas if we were keeping all of that debt, we might be looking at 5-10 year terms. In reality, the stuff that's relating to water, we don't want to put on a term that's too far beyond transition, because we'll be stuck with a loan instrument that we've been paid for by the entity. So that's a slight nuance to how we would normally plan our loans for the year. So yes.
Through you, Bruce, just, Charlie, the wastewater or the water debt that we have at the moment, that'll be transferred incrementally over a period of time, or will that on the 27th of July, the 8th of July, 2027, that'll whack across the new entity?
The detail of how that's being paid back and how it's being transferred is yet to be finalised.
Okay.
But we wouldn't want to have that maturing too far into the year afterwards. But equally, as we found out last time, it's probably not a good idea to have it maturing on the 1st of July 2027 either, because even if the entity is up and running and operating, they're unlikely to have sorted themselves out for paying us from a loan that they'll take on themselves anyway. So we'll look at that. Earl and I will plan that as we come up towards the maturity dates of these instruments, so that we're bearing that in mind.
So it may well be that the entity would service that debt, even though you may hold the debt.
We might keep hold of the instrument and they'll pay us the servicing costs.
Instrument being the debt.
The debt.
Okay.
The loan, yes. So the instrument is the loan.
Okay, yeah, no,
Contract for.
yeah, I have heard the terminology.
Does that mean we have to change the security for the debt? Because at the moment we'll be over the ratepayers, or is in effect, once it becomes a responsibility of the WSO, we'd have to change the security because we're not going to put a ratepayer.
All of our borrowings are with LGFA and they are remaining very flexible on how they treat things like that at the moment. They are working with councils and CCOs on that transfer arrangement. So I have no concerns about it at all.
I don't have any broad concerns, but you have a contract for the bad day when something does go wrong. And I think the real question here is if for some reason oversight, whatever, the WSO was the default, we shouldn't, essentially, why would we pick up the tab? That's their problem, not ours, but it's still on our books.
Yeah, I feel that
It's not, I'm not overly worried. I'm just saying I do, because you guys are clearly working through how to establish a company, but I would be interested how that gets ultimately transferred. The question probably, which I look at, I absolutely take your point, Charlie. You've got to work through what is the best way that protects both council, but also is fair for the WSO and the directors that pick this one up. This should be a conversation which is also occurring with the other three parties to the agreement. Is that happening as well?
I think we're a bit early.
Really? Okay.
it's 2 weeks, it's a week and a half or so until we're actually all adopting the WSO.
That's fair. Oh, okay.
So
You haven't all adopted yet?
No,
Yeah.
Oh, okay. Sorry. I thought it was a done deal. I thought we were all running 100 miles an hour. No.
First plans go through next Wednesday, all for council.
That's a fair point.
And then we will move from there to DIA. And once we get DIA clearance, we'll move to transition. So I think we're a bit early to have those conversations.
Good.
they're in our heads, but not.
Well, you're right.
Tell.
You're right. It's early, but actually, as these things mature, you've got to make plans.
Yeah. And we're regularly meeting.
Point.
Yeah, we're regularly meeting with Andrew from LGFA and discussing these things. Yeah.
And we do have the programme director who's working with all four councils to work on the transition plans.
Yeah. No, I appreciate that. Okay, that's again another little insight to part of the balance sheet, but probably a critical part, the financing side. Is there any questions or, are we going to invite this, do we want Earl in now? Or we're going to make
Probably makes sense to get.
Earl now? Yeah, sorry. Well, welcome to the meeting. You are.
Good morning, everybody.
So I hadn't realised. Sure, with me.
You know, I've been listening with great interest to some of the conversations.
Good. Which part of the world are you in, Earl? Last time it was,
That background is unfortunately not where I am. But I'm at home on Waiheke. It's a beautiful day. So yeah, it's a bit chilly, but yeah, we're drying out after some excessive rain over the last, well, seems forever really.
Great. Well, look, thank you. As you can see, you know, where we are in our conversation. We're just obviously a bit of chat about debt and WSOs. So we do have your report in the back of our papers as well. So perhaps it's a good time for you to just give us your update, please.
Sure. Just before I start that, I'd just like to congratulate Janice as well. I've worked with her for many years, and you've got a good one there, that's for sure. You're very lucky. So congratulations, Janice. And just quickly, your comments around the water services. We're doing a lot of work in this area with councils and with internal affairs, etc. And I think your approach is absolutely right. And my suggestion would be that once it's all approved, that the council tries to take a lead approach and sort of I think being a sort of the most vocal council in the new group is probably a good way to be, because then you can get what you want. So that would be a bit of advice. And a couple of the councils we're working with where we're trying to get them to sort of be the leaders, of how, because the new organisations have got to work out their structure and, as you say, their funding, their treasury policy, and they're not going to hit the ground running. They're going to hit the ground sort of crawling and then starting to walk and then run. So I think it's the council, if you're proactive, I think it'll be a good result for you. And we can work with Charlie and Janice about that anyway. But certainly your approach is looking pretty good. Okay, so if I share my screen, can everybody see that report? Does that work? Okay, so first of all, current debt, we've got 28.8, as Charlie and Millie pointed out, and we are outside the Treasury policy bands, but as I highlighted last meeting, that's within the CEO's discretion, and until debt gets above 30 million, all hedging is at the CEO's discretion, and that's how we're operating. So there's no need for any approval from council. It's just a note. I also note that given the uncertainties around debt transitions and things to water in 2027, there may be situations where we may want to be a bit more flexible and bring things to council, but that's we'll work with that, and that's down the track. But certainly we're very cognizant of the fact that there needs to be a recognition of, we don't want to be doing our 10-year funding for the council when it might disappear in 3 years. That would be pretty silly. So all those kind of things will be taken into account. But at the moment, as I say, so you're we're compliant with the policy because we're under CEO discretion. You've already seen the debt. So getting quickly to the guts of it. So we've really seen markets stabilise a bit over the last few months. We're getting to sort of the end game for tariffs. We have been confirmed at 15%, which is a bit unfortunate considering Australia stayed at 10%. But I suppose they're spending $400 billion over X years on nuclear submarines, you get a bit of a discount. So I'm thinking we probably saved a bit of money not having to have nuclear submarines, and I'd take the 15% instead, I think. So net, it's not too bad a result for New Zealand Inc. It's not great for the wine industry. The part of our client base which is seeing the worst impact of these tariffs is the wine industry at this stage, which is obviously very important for your area. And the main reason for that is, and especially the Sauvignon Blanc guys, so that's more down Marlborough around there, but there's very little ability to put up the price in the US at the moment, and the US wholesalers and sort of middlemen are not that keen to wear too much of the cost. So there has been some quite big pressure on wine margins. Dairy and meat, there's a shortage. So the consumer's got to pay up. So that's been okay. But certainly we do note that the wine industry may be under a little bit of a pressure, especially those that where the bulk of their exports go to the US. And that's, typically those white wines, the Sauvignon Blancs of the world. But that is one area that the tariffs are hurting. There's no doubt about that. So now we've sort of got to a situation where the tariff outlook is rather clearer, and Trump has extended the truce with China for another 90 days to November, so they're still negotiating where they're going to land. So that hasn't blown up, which is good news because obviously China is one of our major trading partners. So investors are increasingly focusing on what's happening in the real world. US data is continuing to weaken. We've got weaker employment in the US, so the expectations now are lower rates in the US. And as you know, probably in the paper you've been reading or whatever, or on the news, there's often comments from Trump about he's upset with the Federal Reserve because they're not cutting rates quick enough. The Federal Reserve, like our central bank, is independent, and they've rightly so pushed back on those calls, and they're running monetary policy how they think they should. But certainly the market is expecting the Federal Reserve to cut interest rates in the US by between 0.5% and 1% over the next 12 months. And certainly there'll be a rate cut coming, I think, in September in the US. Here in New Zealand, a rate cut in August at the end of this month is a certainty. It would be probably one of the biggest shocks from the central bank if they didn't cut. There is no reason for them not to cut in August. They paused in July saying they were happy to see some more data. All the data since then has been around about what they expected or weaker. So, we cannot think of you can't say 100%, but it's got to be 99.9%. They will cut to 3% in August. And we expect at least one more cut this cycle. Whether it comes in November or Q1 next year, we're not sure. But we think the domestic economy is weak enough that they will have to have further stimulus and move the cash rate down towards the bottom of their neutral range. Their neutral range for the cash rate is 2.5 to 3.5. So neutral means it's not stimulatory or not contractory. We're currently at 3.25, so we're sort of at the top of that neutral range. We think they need to get down towards the bottom of the neutral range to actually give the domestic economy some kind of support. Because while the export sector is strong, certainly the domestic economy is under pressure. So from a interest rate risk management point of view, you're very well placed, of course, because we're positioned for lower cash rate over the next little while, and that's going to be where we're going to be able to minimise your interest expense as much as possible. So by having aggressive, excellent working capital management now. So we don't, we keep our cash balances at levels that are, minimum. We don't borrow to have excess cash. So the cash is there for working capital. Your debts remained, around current levels. So the best way to save interest expense is not have the borrowing in the first place, but the second best thing is to have the, to try and minimise those interest costs. And we're pretty well, place for that. So our outlook for the rest of 25 is pretty lackluster. The further rate cuts will help, but they're certainly we're not going to see a boom. And we see a recovery a recovery that's sort of reasonable, not sort of grumpy like it has been recently. Probably not till second half of 26. So there's still a bit of pain for households, and there's still some certain weakness in the domestic economy to come yet. Quickly, that's the CPI. So as you can see, the central bank and government got it wrong during COVID. Their view was that you could actually blow up the money supply, and economics theory had changed, and it didn't cause inflation. We were in a new regime, and things, 100 years of learnings and the learnings from Adam Smith from the 17th and 18th century was all wrong, and huge amounts of increases in demand weren't going to increase prices. Well, that turned out to be wrong, but that's reversed back pretty quickly. And as we see, all the CPI indicators in New Zealand are within target now. And while they might flick up a little bit in the short term, certainly there's no reason for the inflation outlook to cause a problem with that rate cut later this month. And if we look at the and inflation expectations have come down a lot too. So at the peak after COVID, people were expecting inflation to be over 5%. Now the general consensus from corporates and the market is that, and from consumers, is that inflation's anchored between 1 and 3, which is, inflation expectations are important because if people think inflation's going to be higher, it becomes self-fulfilling, doesn't it? So so certainly inflation expectations have come back to normal levels, and that's helpful as well for the Reserve Bank to cut rates further. And global inflation is behaving as well. Almost all there's only two real outliers between sort of that 2.5% midpoint for what most central banks target. The UK has had a bit of a spike up, and that's been driven by, well, the US economy's, they've got some serious issues. You know, the government's continuing to borrow and excessively, and they've got high energy costs and things like that. So the UK is sort of like one extreme, and then you've got China, which is still in deflationary mode. And China's mainly in deflationary mode because of a lack of demand at the consumer level. So, but from a global point of view, from 2022, when everybody was suffering, you know, high levels of inflation, and even China got towards 3%, global inflation has normalised, and so that's another thing that would support the Reserve Bank cutting interest rates a bit more. And as we go into what we're expecting, so the market's expecting the rate in the US this time next year to be sort of closer to 3, same as in Australia, and the market here is pricing and will be around 2.75. So the market here is certainly anticipating a cash rate of 2.75 this cycle. And we'll get an update for the Reserve Bank in August what they think. In their last update in May, they saw the bottom of the OCR at 2.85%, so they were sort of in a two-way bet, saying it'll be somewhere between 2.75 and 3. We suspect they'll continue with that kind of outlook, but maybe they'll snug it down a little bit. But certainly, the market is expecting cuts to 2.75%. And history supports it as well. Typically, we'll see 50 to 100 basis points lower than neutral in a normal easing cycle, not one that's in a crisis. And that would imply that the cash rate should be, you know, closer to 250 than 3, that's for sure. So, you know, all these things point to a lower cash rate, which is going to be good for council borrowing costs and good for your, you know, your ratepayers as well, no doubt. And there's the 2-year rate. It's around 3%. And that seems to be stabilising, and that implies a cash rate at around 275. The 5-year swap rate, which our longer term funding would be, that's closer to sort of 3.5%, and that's more influenced by US moves, the long-term moves in the US. And currently the US 10-year bond yields is holding above 4.2% despite rate cuts expected by the Federal Reserve. And what that means is that, you know, short-term rates in New Zealand are much lower than long-term rates. That's called a positive yield curve. In other words, the interest rate you pay for 5 years is higher than 1 day, which is kind of conceptually makes sense because you're giving your money for 5 years rather than 24 hours. So the risk of getting your money back is a lot higher. But we've had a negative yield curve for quite a long time. A negative yield curve meant that it was cheaper to lock in long-term borrowing than borrow short-term. That's certainly changed now, and that's another reason, you know, the way we're looking to construct your debt hedging is that, you know, the best place to be at the moment is borrow as much as we can short, but be prudent with, you know, managing risk. Now, getting back to the local economy, the RBNZ does this nowcast now, which they look at short-term factors to try and work out where GDP is going, because the problem with our stats department is that we'll get June GDP numbers at the end of September. So the quarter will have finished 3 months ago when we get the growth stats. So they're pretty, they're almost useless. They're so late. So these nowcasts take into account a whole lot of short-term factors, and they try to project so the Reserve Bank's got to be forward-looking, not backward-looking, really. So they're trying to get a feel of what's going on. So for the March quarter, they was expecting growth of around about 0.7, and it came in at 0.8. So for this current quarter, the June quarter, these forecasts are saying, well, growth's going to be towards 0. Some banks are anticipating we will have gone into recession in the June quarter. But growth is certainly going to be a decline in GDP growth over the second quarter of this year. And the current forecasts for the quarter we're in are implying that the economy will contract. So the risk is if June actually ends up being a contraction and this quarter ends up contraction, New Zealand's back into recession again. So again, this is data that the Reserve Bank's monitoring. On the face of that, we can't think of reasons why they wouldn't be cutting interest rates more. The economy needs more stimulation. There's no doubt about it. And one of the reasons we're seeing problems is that unemployment's certainly starting to increase. It's not quite so bad in the regions because of the strong agricultural exports, but certainly in Auckland, unemployment's now at 6.1%, and that hasn't met, that's GFC, global financial crisis levels. The average, the economy is 5.2, but Auckland's 6.1. Now Auckland's a third of the economy, right? So when Auckland's got an unemployment rate of 6.1%, you can see that the non-agricultural sector's got a few issues. And youth unemployment is really starting to surge. You know, we're up sort of 10, 11, 12%. So that's getting back towards global financial crisis levels as well. So the employment outlook is not great, and that's another reason why these guys are going to have to cut interest rates. And this unemployment is at the same time as we've got collapsing immigration. So, you know, so you're sort of thinking, hang on a minute, you know, we got 100,000 immigrants and now we're getting like 20,000 net and unemployment soaring. So it just goes to show how fundamentally weak the job market is at the moment, right? So, you know, and it's the worst parts of the cities. So the regional sectors are doing a lot better because of agricultural exports. But overall consumer confidence is still negative. Main reason is that, unfortunately, you guys are in here as well. Central and local government charges up around 10% increases. So households are getting squeezed when you add insurance and energy cost increases coming through. So energy costs are increasing as Transpower ups its charges as it fixes up the grid, you know. So the old story in New Zealand, we've been a bit sort of light on infrastructure spend. Now the chickens are coming home to roost. We're having to fix everything. So energy costs are going up a lot. You know, a lot of those, as we know, the local government charges are because of, you know, a lot of central government imposed costs, but certainly central government itself is actually increasing costs. So when households have got insurance bills up 40% in the last 5 years, rates up, say 40% in the last 5 years on average, government charges up quite substantially, and energy costs up, you can see why households, despite lower interest rates, are not opening their wallets and spending aggressively like previous cycles. So, you know, this is why this easing cycle is very different to previous easing cycles in New Zealand. Household budgets are still under pressure, and immigration is low, and house prices are flat at best. So there's no wealth effect. People aren't borrowing against their houses to buy new cars, which is probably a good thing in the long run for the country. But certainly this is why some people seem a bit confused why this massive cut in interest rates is not seeing the economy boom. The reason why is there's some fundamental things holding the economy back, and adding 70 billion of debt, government debt over 4 years is certainly not helpful. So the good news, I suppose, is that if you look at what's happening to mortgage repayments, so lower interest rates are not leading to spending, which is bad for growth, but people are maintaining their mortgage payments if they can. So principal repayments are actually at record levels. So excess payments. So in other words, when interest rates go down, people aren't going, oh, that gives me another $100 a week to spend. People are going, I'm going to try and continue to pay that money and get my mortgage down. Because people are realizing that $1 million mortgages taken out during COVID in the housing bubble probably wasn't the smartest thing to do. So we are starting to see some logical behavior from consumers about borrowing. So they're saying, if we can, we're going to repay debt by keeping those payments where they were. So that black line shows, you know, there's a very significant increase between what they need to be repaying and what they are repaying. So that's probably in the medium term is fundamentally quite a good news story for New Zealand households' financial welfare, quite frankly. But that doesn't happen in previous cycles. That never happens. If you get a mortgage cut, people just spend it. This time it's different, and that's another reason why it's tough for retail and other areas of the economy, because people aren't consuming. They're saying, I'm going to save, and that's reflected in card spending. You know, basically flat, despite lower interest rates and a still growing economy, a growing population, albeit slowed down quite a bit now. You know, retail card spending is flat or declining, quite frankly. So as people are being much more cautious in their spend, as we're all probably aware. You know, we've all got friends in business who are, you know, the story, it's tough out there because people aren't spending. They're spending what they have to, not what they might think they'd like to do. And tourism's been quite good. It's been a good recovery from COVID, but certainly that's stalled now. And it's around 80% of pre-COVID numbers. So we saw a big boom in tourism, but it started from a zero base. So that sort of masks that in general terms, tourism numbers are still below COVID levels. There's a few factors there, that mainly is the Chinese aren't traveling anywhere as much as they were doing long haul. And we got a big boom from the United States, but things are tightening up there a bit. So maybe that will be a bit less, but certainly tourism has been a positive. And that was a big contributor to growth in the economy over the last couple of years, but certainly that's going sideways now. And unfortunately, while, well, not unfortunately, the reality is that despite the excess repayments by households, bank lending is still focused on housing, not the useful sector of the economy that does things and export stuff and makes us money as a country. So agricultural lending is actually negative. It's almost getting back towards zero. One of the reasons there is we're seeing a lot of farmers actually using the high dairy payout, for example, and higher meat prices to repay debt rather than spend on, expanding the farm or doing bits and pieces. The reality is that the non-corporate farmers are aging, and they're looking to get their finances in order as they approach, what a takeout time for the farm and what they're going to do with that farm. And dairy industry's got a lot of issues because it doesn't seem as though the young people in the family want to be dairy farmers. They want to be IT people or whatever, or graphic artists, or influencers or something. So it's hard to talk the kids into taking over the dairy farm. So, but we are seeing debt being repaid in the agricultural sector. So that's not, whereas previously from sort of 19 through to 24 was driven by the banks weren't lending to the agricultural sector, right? Now the banks are sort of a bit more ambivalent, that it's just that debt's being repaid. And we look at business demand for credit is certainly declining. And that's a factor of, what they're seeing in their business operations. But we are starting to see house lending. The banks are aggressively chasing housing lending with specials, because that's a market that they make really good money, and they believe their credit risk is the lowest. And in fact, the Reserve Bank rewards them for lending to housing rather than business or agriculture, because they have to have less capital against that lending. So there's always been a bias in New Zealand from a return point of view from the banks for lending. And you can see, bank economists are always talking about our house prices may be going down. Now they'll be going up next year, because it's in their interest to have people borrowing more. And that's starting to pick up again, which is kind of fundamentally a bit of a concern, because we need to be actually producing stuff that we can sell to the rest of the world, not buying and selling houses off each other. But that's another story. But certainly, that means that the economy is going to be flat for a while yet, because the lending to the productive sector, quite frankly, is woeful. And GDP per capita is pretty bad as well. So, this is a nice depressing start to your morning, isn't it?
Love it.
So when we see GDP, right? So the government, and they're all as bad as each other. The Key government, the Ardern government, doesn't matter who was in power. They all tried to play the game where, GDP's gone up by 3%, the country's growing. Well, unfortunately, per capita, it was actually going down, because the headline GDP number was going up because we had huge, very massive levels of immigration, right? So if you get 200,000 people arrive in a couple of years, they go and buy a phone or a car or whatever. So they spend a bit more money. So GDP, the gross level of GDP goes up. But when you divide the total GDP of the country by the people here, we're all getting poorer, because it wasn't targeted immigration. We weren't spending on infrastructure. It was all very poorly done. So this current decline in per capita GDP is actually the worst we've seen in any of the major crises since the wool bust in the 60s. So that's a pretty sobering. So when politicians talk about we want to pump up immigration again because that's the answer to New Zealand's growth problems and financial problems, it kind of doesn't look as though it is here. It needs to be done properly. It needs to be targeted, and we need to have the infrastructure spend to support it. So all very well in having 300,000 more people in Auckland, but if you've got no more schools and no more hospitals and the roads are the same, it just causes issues for everybody, right? So these are the chickens that are coming home to roost. And that's why everybody's now starting to focus on a infrastructure deficit, not just local government, central government. And that's why you're seeing politicians on both sides of the house now talking about, oh, we've got to get away from just buying and selling houses off each other. Well, they've been fostering that for 20 years. So I'm thinking, you know, whether you're Labor, National, or whoever you are, this problem has been around a long, long time, and it's going to take a while to fix. So that's why we think that this recovery is actually going to be bumpy for a while yet, because we're actually starting to address issues that have built up over 30 years. You know, this is not, this can't all be sheeted back to COVID. It can't all be sheeted back to, you know, a few bits and pieces. They didn't help, and the extravagant borrowings of the government during COVID and the extravagant money printing by the Reserve Bank during COVID, which was, I think, twice as bad as what the government did. They were issues, but they fundamentally were just making it worse. They weren't the cause. So this is a sobering sort of look. So that's why your ratepayers are under pressure, because everybody's a little bit poorer. Because we're all paying for the infrastructure to now rebuild the country. We're all paying for the energy. We're all paying for all these things to get the country back to how it should be to support the population. And we sort of haven't got the cash flow as a nation to do it quite. So that's why it's a bit grumpy out there. But there's some good news. There's always got to be some good news, right? And the low exchange rate has been very helpful indeed for the export sector. So the red line is US dollar prices, which have been, you know, have come up a lot since 2023, and they're sort of flatlining now. The black prices are in New Zealand dollar terms, and they're at record highs because we've got strong dairy prices and a weak currency. Historically, if we had strong export prices, the New Zealand dollar would go up, and that would sort of, you know, offset some of that benefit. But at the moment in the dairy industry, you've got, you know, very high prices, and in the meat industries, very high prices, and you've got an exchange rate close to decade lows. So that's a real benefit for the export sector, and that's been a real silver lining, and we need that to continue. But that is very, very helpful, and that's been one of the reasons why the economy is actually managing to sort of hang around sort of that flat growth rather than recession after recession after recession, because this export sector is helping us. The big fundamental problem is that exports are less than 30% of our total GDP. In 1970, they were about 30% of GDP. So in the last 50 years, we haven't increased exports as a percentage of our GDP, whereas countries like Ireland have doubled them. Denmark have gone up by 40%. So as a country that exports to the rest of the world, our export performance has been pretty poor. So the export sector is doing all it can to support the rest of us, but it's not big enough to offset the problems that households are facing on costs at the moment. And that's why you're seeing in this export boom in the rural areas is not flowing through to a boom in the economy in general for this and other factors. So that's why people are surprised how these cuts in interest rates aren't giving us the normal benefit we see, because the usual house of cards suspects, higher house prices, let's go and borrow and buy a new car, or immigration pretending that GDP is going up, they're not existing at the moment. So we're actually having to show the real numbers for the economy. So this is a real good story for the regions and for New Zealand Inc., but it's not big enough, unfortunately. So that's why we still think that growth is going to be problematical for the next 12 months or so. And on that note, that's it. So there was some good news at the end, and the other good news for the council is that you're very well placed to take advantage of lower interest rates. So that means your financing costs for your ratepayers are hopefully going to be, you know, they're going to be a positive for them over the next little while, that's for sure.
Thank you for that, Earl. That actually has been well worth time. I was thinking not so much, well, actually, we've got it for an election cycle, so we should be thinking about that from an election perspective, but actually as we head towards the next annual plan. These are long-term, well, these are moderate-term issues that will be with us. Do we have questions for Earl at this stage? Yes, Mark.
But there's a question, but more a correction. Partway through, Earl, you made it may have just been a throwaway comment that New Zealand hadn't been spending much on infrastructure. That is quite wrong. New Zealand is one of the highest spenders per capita on infrastructure in the OECD, at least in the top 10%. What is happening, however, is we are wasteful spenders on infrastructure, and we do not get value for money. And that applies to councils as well as central government.
Yeah, actually, you're absolutely correct. I should have said our infrastructure outcomes are woeful, not our expenditure, because it's like the trains here in Auckland. 5 billion, whereas in Italy, and we always used to laugh about how the Italians didn't do much. They'd build the same thing in half the time for 2 billion, and things like that. So certainly, yeah, we spend a lot of money, but we're not that great at spending it so far, are we?
It's true.
Any other questions for Earl? Well, one of the things that's been in my mind was Standard & Poor's talked about actually a downgrade for New Zealand as a whole. You haven't made any comment on that. Is that a real possibility? And what would that mean?
Yeah, it never used to be. We'd sort of get away with it because our headline debt, so government debt as a percentage of GDP is, less than 50%. It's say high 30s and maybe might get to 40. And, people are talking about 50%. So in isolation, that number looks quite good. The problem is that if we got anywhere near there, we would be subject to downgrade, we believe. And so the chances of a downgrade now are probably gone from 10% to about 20 or 30%. So if we continue with government deficits, and the current government isn't decreasing borrowing at all, it's just slowed down the rate of increase, and they're talking about surplus in 2028, and we're talking about a razor thin surplus, right? So certainly the risks of a downgrade are higher, but it's not in our base case. If we got a downgrade, that would probably increase our overall cost of funds by 10 or 15 basis points. So it's not life threatening. So rather than, we might pay, let's say we pay 20 basis points more, but when you've got $200 billion worth of debt, 20 basis points is quite a big number. So it would be an inconvenience, but it's not going to threaten us at this stage because, we're still a relatively high credit rating, but certainly it is a factor that is increasing. Because fiscally, we're getting in a situation where, as a small country that is subject to shocks, like we've got earthquake risk, we've got flood risk, we're subject to sort of global risks that hit our economy. We can't have 100% debt to GDP ratios like the China or the US or these places that are big countries with big armies and all this kind of stuff. We have to be much more fiscally responsible. So anywhere near 50% would be looked on as a real red flag by those rating agencies, and we're still creeping higher at the moment.
Thank you. Yes, Woody.
What do you think? Thanks very much, Earl. It's quite interesting. Just a curiosity question. The GDP per capita, when was the last time this country was on the positive side of that, not the negative side?
I think we were growing positively about 4 years ago, and we're talking at the margins. GDP growth per capita being positive has been at the margin of error. We have. And the other problem we face, and it's not just a New Zealand problem, it's the Western world and Australia. The Reserve Bank yesterday talked about it. Our productivity growth is woeful as well. So when you've got, and that's a big contributor to why our GDP per capita is not going up. So if you've got high levels of population growth, and they're actually adding GDP at a greater rate than the average, that helps as well. But our productivity is actually negative. So not only so we've actually got a situation where we're becoming more inefficient. So that's not that, and so there's not just one or two factors that are causing this GDP per head thing, but there's a malaise in our country and how we do things. And when you spend double to get, if you can build a bridge for 50 million and we spend 100 million of it, that's not a good outcome. There's 50 million slopping around, but from a productivity point of view, that's woeful as well. So there's a lot of factors that have come home to roost now. And because our debt levels are quite high, it's going to be difficult to get that productivity, that GDP per capita up anytime soon. And it's going to be a big multi-party effort and a big sacrifice from New Zealanders to start to get that productivity going up as well. And, you know, do we have the political will to do it? I don't know.
It's interesting.
Okay, I think that's probably all time we can take on this, but that has been incredibly informative. And I'm sensing in the room our appreciation that you've given us a sense of where we are, even with our going back to your original point, the importance of our capital management, maintaining our funding, the right proportions in the way that we've said, again, is important from our planning perspective. So thank you for being with us this morning. That's really great. Thank you all.
No, pleasure. And just one last thing, when we do a survey of council's cost of funds, you're in the top 10%, as in the best, not the worst. So your overall cost of funds are your overall costs of funds are some of the best in the country when it comes to council land, and we don't see that changing anytime soon. So again, Janice and the team doing a great job, and to look after the funds for the council. So good on everybody.
Thank you.
That's the question.
Cheers. Bye, everybody.
Thanks, Randall. So look, well, there are one or two minor items left, but well, minor, important items left in the financial report. Do you want to talk to those, Charlie?
Pretty quick.
Yeah, why don't you do that? Sylvia?
Yeah. So the debtors at year end is actually looking fairly positive since this report, because we don't obviously change it afterwards. You have to take your snapshot as and when. Some of the building consents, some of the regulatory payments have all been made. So those have gone down quite significantly. Obviously, with legal costs on debt, you only get those paid back when you recover your debt anyway. So those can get quite old, depending on the action that we take to recover the debt in the first place. Resource and planning has gone down in terms of overdue significant. So I'm not too bothered about these. And of course, at year end, you've got a lot of current debtors because you've just issued things like dog registration invoices that aren't due to be paid until 31 July. So this is actually quite a very positive report, I think, and helps with our cash flow as well. In terms of rates arrears, we have noticed a bit of a trend in terms of one of our towns, Greytown, the number of properties has increased. But 22 properties, but that pretty much brings it on a level with the other two towns, whereas traditionally Greytown has been quite low in its arrears levels. Thinking about the reasoning for this was the first year that we switched to capital value. And if you think about the makeup of Greytown, it would probably be fair to say that there are quite a significant number of people on fixed incomes there who have properties that have increased over the years in capital value. But we are definitely working with the residents. We've gone up to just under 50 payment plans, and we're just reviewing those for the new year now, helping people paying by direct debit, which obviously we add the arrears to their direct debit amount. And we do always mention the postponement scheme. It's still not been taken up by anyone. That's probably a reflection of the fact that we're very flexible with our repayment plans. People don't feel like they need to postpone their debts because they're able to work with us on smaller payments. So we do have one rating sale that's in the process, and that's on vacant land. So this is something to watch, but we're increasingly encouraging people to contact us. Rates rebate scheme is getting more and more popular, and more people are able to access that now, partly because of the higher threshold with the superannuation, and partly just because more people are falling within the income thresholds.
When you say Greytown, do you mean urban Greytown or the ward?
The ward.
Any other questions for Charlie on the remaining part? Yes, Bob?
I think, is just explaining like the cost of living increases as well. It's just, you know.
Yeah.
The standard bond on everybody, just, not just capital there.
Yes, I think, Bob, I think a lot of what Bill was saying, driving process, the next year's annual plan, is that, you know, what was it, July 25? Well, it ain't 25, and at best, it's going to be a part of the new rating year before you get any benefit, and so it's going to be a tough year to
Yeah, and if we,
really plan to.
if you talk to small businesses and people with accommodation out to this bonus will be all down.
But yeah, in fact, I think we should probably move on. Thank you for that, Millie and Charlie. I think that's again really helpful. And I'm conscious that we've got our auditors behind us as well. So we've got an audit matter to get to as well, which is good because you've given us a heads up on 30 June, but we're also in the process of trying to put a nail, I'm about to put a nail in this coffin. I think it's a good analogy, but you know what I mean? It's trying to get to a conclusion. So the proposed resolutions are we received the draft. There isn't any particular matters around tax that's been identified, nor do we have breaches of policy. And just reflecting on Earl raising with us the interest rate bands, the fixed interest rate bands, which we are at one level pictorially complying with, but in terms of our policy, we are because we're under $30 million and you've got the discretion to do it. Plus, we've had a substantial explanation from Earl why that isn't a position that we are at great risk in. So it shouldn't attract any greater attention from us at this point. Do I have a person prepared to move those resolutions? Thank you, qualified seconder. Thank you, Karen. Appreciate that. For the motion, all those in favour, please say aye.
Aye.
Those against, it's carried. Thank you. So we're into our whole swathe of information reports. I say that because I keep trying to pass motions at the end of each of them, don't I, Jan? Which I am doing assiduously not to do today. But look, I think it's worthwhile just taking a break because behind me, it's good to see you, Bruce Robertson here. Been a long time, buddy. So welcome back into the Audit New Zealand fold. Jim, I think it's fair to say, I think it was last week, you met with Audit New Zealand and Sefton as our new director was introduced because Karen Young left the office, I think last week or whatever it was, or tomorrow, this Friday, and Sefton is taking over. So that's tremendous to have you on board. I can say he's a good man. He came out of Dunedin, or at least part of his career has been in Dunedin, so he's good at Otago man, aren't you, Sefton? So Sefton's on board. Sefton, look, just for the benefit of the meeting, I just wonder for you and Latif, if there's anything you'd like to say at the staff before we consider the paper.
Yeah, just very quickly, it's a pleasure to meet the audit and risk finance audit and risk committee. We met with the Janice and Charlie and Stefan last week. It was a great meeting. It's a good introduction, and we're obviously looking to carry that forward and with the council as well going forward.
I understand there were donuts on the table as well. I wasn't there, but anyway, there you go. Charlie, is there anything you'd like to say to your report? I mean, it's fairly run of the mill. We're in the process of doing the audit, but is there perhaps just a short update on where we are with that? And I'll ask Sefton and Letitia to respond quickly.
Absolutely. So we in finance are busily just doing our lovely business that we love doing of our journals and finalising our year-end accounts and getting ready to start loading things onto the audit dashboard, which is the way that we transmit our information to them. It's a nice, secure platform that audit have delivered in the last few years, and it has made communication much easier with audit. There used to be hundreds of emails flying around everywhere, but now we just upload everything onto that nice dashboard. So that's a really good move. That would be fair that the customers of audit have been after for quite some time, and they've delivered that well. So we are in that process at the moment, and our audit starts for final on the 15th of September. Now, that is a ambitious timeline, but an achievable timeline to get the papers to you ready for adoption on the 8th of October. We, as you remember, we went with a pre-election or annual report adoption, because as you remember from your beginning of your training, it was probably one of the first things you were asked to do was adopt an annual report to do with before when you arrived. So we prefer to adopt before election if we can. The aim is still to do that, but the legislative deadline is still 31 October. So that we do have a bit of wiggle room if we need to. We are not anticipating any reason at the moment for needing that. The accounts of the year, as you've just heard, are very close to budget, and our revaluation is probably the thing that has needed most looking at, and we have done some work already in a pre-final week on that. Just a few loose ends to tie up with that in terms of justification for the statistics that we've used for it. So quite happy with everything and how it's going. It's very handy having Millie on board. It's very nice to have someone else doing a lot of the work in the background, so that's very good. And the team are now very experienced. Millie is our newest person and she's been here 2 years now, so it's, yeah.
Well, that's great.
Lovely to have an experienced team on board.
News when we get to compare that with our people report later on. What would be the biggest risk? I've got a number of clients that anticipated pre-October sign, and we've gone to pre-election sign, and we've gone to post-election sign, recognising that while we still have 31 October to get it done by, it doesn't mean to say we can get our auditors back. In fairness to them, because they probably have other things.
No.
What's the biggest risk stopping us from achieving 8 October?
So it would be fair to say that there are a lot of significant disclosures to make this year, both in terms of water reform.
Yeah.
And also we've made that prior year adjustment to our investment properties where we've corrected them to be PPN. So obviously whenever you make a prior year adjustment, you have some disclosure around that to make. Wellington Water and the procurement and investigation that's gone on there, we'll be putting some disclosure around that. We've been working with the other councils in the Wellington Water fold on standardising, making sure that that disclosure is consistent as well. And whenever there's disclosure, there's always back and forth over the wording of it and how clear it is versus how technical it is. Disclosure, the whole point is so that you're informing your readers of your report of significant things, and you have to balance that technical accuracy with plain English language, and that can be quite complicated, but we're already working with audit and the other councils on those things. So that's probably where I see the highest risk on that. Yeah.
Thank you. Sefton, I suspect you've been taken on board where Karen's got to, etc. But is there any comments you'd like to make at this stage about the progress of the audit?
Yes, very briefly. We are well placed. We have gone through the interim. We've done the pre-final review, and we are now just waiting for the final audit to take place. We have been in communication with Charlie and the team, and we will continue to do so going forward. I certainly agree with the sentiment expressed by Charlie. In terms of risks, I'd also like to add that the council team is working hard, and we intend to stick very close to them, to it, and make sure that any issues or any communications or any disclosure that they might be challenged with, that we will provide direction to them earlier rather than later. So we're all establishing a early communication agreement. The other thing that Charlie mentioned, and which is also high on my list, is an appreciation for the timeline. The 8th of October is a very ambitious date. We're not saying that we can't achieve that. We're saying that if we work very closely with council, we have got the secure, what's it called, Leticia? The word Dropbox.
Oh, audit dashboard.
Audit dashboard. We will monitor that. We've brought the team. We've got a team secured to start on the 15th, although we've actually got them available, Charlie, from the 8th, so we can actually bring them forward. That is just to give us a little bit of clearance. We're aware that the dates that the papers will go to either the council or the Audit and Risk Committee will be 10 working days prior to the 8th. So that means that we may not have entirely completed the audit review process at that time. We will be able to, we will talk with Charlie and the team and make sure that any variations or anything arising from that, or what the council or the board receive until the date of signing is actually quite clearly marked out, so that we can actually follow that through. There's an audit trail and be in a position to sign without issue on the 8th of October.
Just from my end to include, sorry, another area of concern that I think that wasn't raised was that the council has rectified the traffic count issue this year. So we have not been able to look at that at pre-final because it was quite early. But that's also top of mind for us in terms of where we land.
And we got qualified last year for this.
We did, but that was basically because of a piece of equipment that couldn't do the traffic counts.
Yeah.
That's been secured, and Tim has assured me since back in December that we are compliant now. So
Yeah.
I'm not anticipating that.
It won't correct last year's position.
Yeah.
But that's good. I'm appreciative of that, Letitia and Sefton. That's great to know. Just one sort of wee piece of perhaps request from me, Sefton.
Sure.
I don't want to be audited through dashboard. It's a very convenient means of transferring information. But we aren't that far apart. It's only a trip over the hill. I think if there are questions or issues, I would really encourage face-to-face conversation. But that really clears the matters up fast.
Our plan is to be.
Yeah.
All I'm requesting is that when we have, as inevitably you do an audit, some differing views, we need to resolve them. That's best done face-to-face. Letitia,
Yes.
would you like to respond to that?
I'll just start, Bruce. Yes, it's totally my style. I might be old school. I prefer face-to-face
I'll be called
meetings.
old school that you, Sefton, don't worry.
Well, it's my preferred mode of operation. The audit team will be on site, and that's what we've just negotiated internally, rather than to do by Dropbox, do an audit by Dropbox, because I think the nuances of the information, etc., is lost by just dropping them cold. Certainly, that's what we aim to do this time. Leticia?
Yep, I definitely agree. I think we have established from our pre-final audit that it really works well, the team being on site, and yeah, so we definitely have a team to be on site and with regular engagement with the finance team to ensure that, you know, we're all on the same page.
Great. That's good. That's good news. Do we have any other questions for either Charlie or the audit team here?
Comment, I think, Bruce,
Yeah.
Chair, is I think given this council's experience in the Office of the Audit, the last this triennium, I don't quite share the optimism. Nothing probably for Charlie from you, but good luck with this. But I would be very surprised if we actually see this.
On the 8th.
On the 8th, yeah.
Well, you're right. And I think Sefton is saying this is significantly ambitious. So I'm prepared to say at this stage, you have a good crack. Sefton, be old fashioned and be on site. Is my advice. That gives us, that actually, gives us our best chance, albeit we need to be prepared for rectify. And I mean, you're warning us as well as ambitious too. So if we can do it, it'll be a great result.
And getting them the information as early as possible gives them the chance to apply any resources free to it. So
It's the first time I've heard Norton say, well, we'll try and bring it forward to the 8th or that stuff. Yes.
But also rigorous.
Yeah, the combination, I agree. Thank you, boss. Rightio, well, we'll take that as received. You're welcome to remain if you wish, Sefton and Latesh, but I suspect you may well be chasing your tail on audits. So it's been great to have seen you at the very least, and certainly at a personal level, Sefton, it would be nice to catch up with you face to face at some stage.
Thanks, Bruce. Thank you very much.
Thank you everyone for your time.
Thanks.
Thank you.
Okay,
Thank you.
right. We're on to the Jen. Well, move up to the risk management, please, if that's okay. Still not risk management.
That's.
You can't. Brilliant. Thanks, buddy.
I think it's here and
Yeah, Stephen.
SLT have recently refreshed the risk documents that are in front of you, and we've made sure, sort of following that the risk session that we had with you previously, we've made sure the document is contains the most recent information, primarily on mitigation, but also we've taken a hard look at each of the strategic risks and make sure we're satisfied with their levels. And we've made some improvements to the way the information is displayed for you. One of them you'll see there is whether the risk has changed by way of an arrow indicating static or up, down. I think the risks are easily understandable, and I don't propose to go through them given the time constraint we've got, but I am happy to answer any questions or receive any feedback on the forms. Thank you.
Brilliant. Thank you for those introductory remarks. That's really good. And again, well done to SLT and you, Stephen, for your lead. Very clear. We're getting advice from you focused to where. Quick questions or comments for Stephen or indeed. Stephen, I think firstly, given the conversation we'd previously had in the workshop, secondly, looking at the broad context of both South Wairarapa and indeed being elected authority, these pretty much follow what I'd expect. But I just wonder if there's a couple of questions that I'd like to have just to understand probably as much the colour, the redness of the two matters that I've looked at that have got in front of me. And one of them firstly starts with regional alignment, which is red, which is, on the surface concerning when we're trying to be regionally aligned over three waters. Is the matter over the library service a one-off, or is that something which is indicating that we are trying to build a water service operator with fractious word, with people we aren't necessarily overly aligned with? You want to do
take that first before Stefan jumps in. I just want to reassure the table that the discussions and negotiations around the Wairarapa Tararua water model are sound. There is no dispute with those arrangements whatsoever. We're all approaching adoption of the water service delivery plan next Wednesday. So we've aligned all of our meetings so that we all adopt on the same day. This risk, and the reason that it's high, is based around the fact that we have now separated from libraries, but there are also other changes happening with climate change and with the regional models that we've had. So whilst there is still some alignment, we feel that there is an increased risk here in what we're seeing around how we currently join up with our neighbours.
I need a, sorry, if I could just ask, do you want to add to that, Steph?
I think, Chair, there's a lot of integration and shared service activity between the councils. Roading is an example of successful integration with Carston, and we've left the door open to that potentially extending to Marston at the end of the contract period. Water is certainly progressing very well and is positive. Waste is another example of where we've collaborated as a region successfully in providing a range of waste and recycling services. There have been a couple of bumps in the road in relation to shared services. One is libraries, which has got its own peculiar set of circumstances. And we've also seen some changes in the way we've approached shared regional staff. And that is having an impact on our ability to understand how we're going to continue to implement strategies like climate change, positive ageing, and contribute to walking and cycling, those sort of areas. But there are other ways of achieving that, and my sense is that we'll move back together eventually on that stuff. It's just at the moment we've moved away from one another in those areas, and that's what this, as Janice said, that's what this risk profile reflects, that current state.
Before I just invite other comments, I'm trying to think strategically about this risk. Sorry, I'm not accusing either of you of not thinking strategically. But if I line this up with perhaps the financial risks, the forecast that we've heard from Earl, and if we think about the other risk here of government reform, and I suspect there will be reform if this government gets a second bite of cherry, our ability to work with our neighbours is really important to preserving local democracy. In other words, how do we bring our costs within an affordable frame set, amongst other things? So that's why my eye has been attracted to this particular issue. I think our future is not necessarily, by the way, I'm not making a political statement here about whether the Wairarapa should be one of the authority, Jan, although I have been a consultant on that before, many years ago. This is actually about how do we, what is the logical way for us to go forward? And I suspect it is strongly around greater regional alignment. Hence, this is on my antennae. If I can give you that warning, Stephen, but thank you for that. I can't take it further than that, other than just to note it's a slight worry. So I've got Colin and then I've got Pat.
Yeah, no, I share your concern, and I'm just wondering what signal this actually sends to our neighbouring councils. Regional alignment has been around the conversation table over a number of years, and there have been 2 attempts to regionally align by way of amalgamation over the previous years as well. The conversation hasn't gone away; it's still there, and in fact, even last night there was a good conversation to be had about what we would look like in the future once Local Waters Fund done well, our water service delivery organisation is set up, and those conversations will reignite again. But my concern is that when we see a red flag like this, what message does that send to our neighbouring councils? You know, is it a trust thing? Is it a financial thing? Stephen, would it be better not amber for caution?
We can adjust.
No, that's your call. Yeah.
Profile with respect to incident, and through you, Chair. I don't think we can adjust the risk profile to reflect the impact that our finding might have on other councils. I think it is what it is, but it isn't a red light that says, you know, It's not accusing, it's not, this isn't a political statement, it just reflects the reality that in a couple of areas recently, we've seen an erosion of our ability to collaborate across the region. It doesn't mean that our intent isn't to try and remedy that, but it definitely is. And it doesn't mean that there aren't areas that are successful, like roading, water and waste. It doesn't mean that there aren't other areas where we continue to see improvement, like in emergency management, where we now have a shared emergency management office, which I think will ultimately make us more effective regionally in that space. If we contribute fully to that, it just reflects the fact that we've had some wobbles in certain areas. We as a council are certainly committed to looking for every opportunity to integrate and share services and to look for models that are efficient in terms of delivery and fiscally efficient. And that's a feature of a discussion that SLC will be having next week, including with our managers and on one of those topics that we'll be looking at is integration and shared services and how we approach that in the lead up to an election period.
Thank you.
Is that your characterisation, Janice?
Thank you. That's very helpful to know as well. So that's definitely the case.
Yes, this made me feel a little disquiet too. And I agree, if you see a risk, we can't adapt the report to say it's not. But Stephen, you did say that there were other ways to get around these issues. And I just kind of wondered what sort of direction they were, because I'd like to sort of maybe have an idea how we might solve these problems. If you could expand on that a little bit.
It's tricky, isn't it? I mean, this rests on strong both political and management intent to deliver through shared models. So it means that fora like combined council, policy group, and other times when all councils are together and thinking about how to do that, are proactive and pointing in that direction. That's one very important thing. So, we'll be looking at how we brief and how we approach those issues in an encouraging and positive way. Once we receive a new governance team. Other than that, we just continue as an organisation to have sensible conversations with our partners on how we deliver climate change, cycling, wastewater roads, etc. Balancing that against the narrative that's coming out of government on what's core and where customers expect us to be delivering and focusing.
Also, is it that outputs it the main disagreement?
Councillor,
I think we just need to be conscious that this is about risk. So this isn't about who's doing what or where and why. This is about advising you with the governance table that we see that the risk profile here has changed. And it's something that as officers that we want to work towards with the new governance team. But we would be remiss if we didn't highlight that there have been, as Stefan says, some bumps in the road recently. And this is just about making you aware that from our perspective, this risk profile has changed. This isn't commenting on the actual on the ground working. This is about the risk profile that we see. So, we remain committed to working collaboratively, as do our other councils in the region. But we're getting towards the end of the triennium. It's really difficult to reignite those conversations, knowing that we will have different voices around the table come October. So it's just really making you aware that from this perspective, the profile has changed.
Thank you.
I just want to pick up Councillor Old's point, which I think I align with, because I actually think turning this from 8 to 12 is totally over-egging something. However, I'd also pick up Stefan's point, which is this is a report from staff and that's their view. But here's why I disagree with their view, because I don't have to agree with it. I can appraise it and I can consider it and I can say, well, really? And in the case, for example, of the library change, which did put people to quite a lot of effort, but actually everybody goes in and borrows their books. For the average person in the public, nothing actually changed. It was a bit of extra work for us, and that service will continue perfectly excellently into the foreseeable future. As for the aged concern, the cycling and the biking and whatever, the average resident has not seen any outcome from any of that for the last 3 years. They will just look on the recent, if you like, parting of the ways with our neighbouring council as an opportunity to save money. I endorse that.
Thank you, Martin. Any other questions or comments? I think I'll come back to my other one later on. I think we've got a bit more further down the track as far as that's concerned. So, folks, do we have any more questions around our risk profile as it stands at the moment? Perhaps the best thing to do is to just look at the graph, the summary graph on page 34, where by essentially ordered by colour coding. Stefan, thank you. You've given us those which all stand at high versus medium versus low. Those are some big items of red. So I think a critical question around particularly something is going up as I've tried to sponsor a discussion around regional alignment. The critical question is, are we happy enough's being done? And Stefan, I've heard enough, by the way. Sorry, long word. From what you have said in terms of regional alignment, the fact that we're still clearly, I think I reflect Earl saying that, you know, you're at the forefront of thinking around debt with the WSO, Jan. To me, that's positive and it shows the right intent and approach, and it's probably what is feasible at the moment. So it's not like I think I can suddenly say, I'm simply going to say go out and find a new joint library service, but you know what I mean. I understand the nature of the work that's carrying on, which is good, plus also recognising do have an election right at the moment, so this has to be revisited in the new training as well from a political perspective. So I think enough's been done there. So it is important when we are particularly with those that are red, are we as governance happy? That's the right word. Comfortable might be a better one, that enough's being done. So just final chance before we move on. Page 34, you've got those risks there. Is there anything else that you'd like to raise about our risk environment with those? Critical asset failure, climate change, regional alignment, water, interim transition arrangements for OPEX. Actually, that was really what I want to go back to, Jan, by the way, but perhaps we can talk about that later. Then government reforms are all red. I'm relatively comfortable, if I can say that, because I don't hear anybody else at the moment talking. I'm relatively comfortable on the basis that there's a fair bit of externality to some of those risks. So again, I'm coming back to what I'm hearing from management internally, which Jan gives me confidence that we are approaching these in the right way. The nature of these are, here I say, probably other than critical asset failure, are ones which are even that can be externally impacted as well. I'm confident that I'm hearing the right intent from management.
Yeah, I guess the colour coding in particular is a little bit of a turn off for me in terms of red and high means extreme in my view, not just high. So we don't have an extreme one, do we, Stefan? So the reality is that they're measuring higher on the scale than obviously than the amber and the green. I guess that's the only way that you can probably really measure it. You see it as a bigger risk factor than that of the other amber and green ones. So yeah, no, I'm happy. Yeah. Not happy, but I'm happy.
Let's see, somewhere else somebody said we're comfortably uncomfortable.
Yeah. I think it's one to
I said if you're a Pink Floyd fan, you'd
Yeah.
Pink Floyd fan, you would say you were comfortably numb, but that's another story.
I think it'll be one to watch
Yeah.
in the coming months about how,
Yeah.
whether or not these things track in a different direction. But yeah,
Stephen, just before I pass on, given this is getting close to the last time we'll look at risk for the new thing, can you just talk to me about the critical asset failure? Sorry, I should have asked you just to comment on that one, because that is a red of whether it's a high or an extreme version. Let's not worry, but it's on that range. I mean, I have the summary here and obviously the details. Anything in particular that you wanted to know? That is probably more in our hands than it is too much else. I could probably be able to help you.
which page is that?
That's, well, if you want the detail, it's on page 65.
Oh, okay, right, yeah. I've read it.
I might actually speak to this a little bit, yeah.
Go for it, Charlie. You're welcome to.
One of
Should be running the engineering function.
One of the things we need to bear in mind is that we do have now more control on our capital program for waters. We have in-house the management of that program, and that should progress some of our assets that we have been waiting for some time. And the other one is that post-transition, we are going to be in a different world of focus, and we will be able to look at some of our other critical assets. Roading has been ticking along quite well for a while, but we will have some debt ceiling available to apply to improving our roading network. So I see this as actually an area where we have opportunity. And as Earl was mentioning earlier, historically, infrastructure investment, both nationally and on the local level, has tailed behind. That doesn't mean that we keep that foot off the pedal. If anything, we need to look at how we can put the foot on the pedal, but in a wise and efficient way. So I see this as sure, at the moment it's a risk, but there's also a lot of opportunity around it.
You got to correct us accountants.
I think, I mean, first of all, Chair, of course, this is exactly the kind of conversation that we need to be having, and we need to be having as in detail. And I think you identified that in the previous meeting, that risk is a dimension of strategy, and it's very, very important that this table engages on a strategic level, including the assessment of risk. And it's worth a deep dive, and certainly I know that's the intent as soon as we have new governance in place. I mean, this risk level reflects the fact that we can't ignore the reality that we're in the middle of an infrastructure crisis in New Zealand, and we're part of that. You know, we have enormous pressure on our critical assets, particularly in water, and we have 7,411 rating units. And that's not going away. Yes, there is promise and opportunity ahead of us. And so, as the Councillor has said, there's some hope in terms of the trajectory, and I share that hope. But there isn't any running away from the reality that our existing assets are under enormous pressure, and we still face a very stiff task in funding them adequately to secure the infrastructure that we need moving forward. And really, that, I think it's fair to say that that's what this flags and continues to flag.
You sobering.
Sobering.
Any other comments? Thank you, then, Stephen, and thank you that you be a bit longer. Any other comments I'd like to make? Okay, that's really helpful, Stephen. Thank you for your hard yards and thank you to SLT. It's music to my ears that I know that this comes with SLT consideration. It's the way it should be. So thank you. Actually, behind the risk paper is also the legal compliance. I've already referred to the level of resource consenting, I think, amongst other things. This looks like a pretty good result. Is there anything around legal compliance or indeed water compliance that folk would like to raise? Can you speak to that, Stefan, or somebody else? Anything?
We'll just take it as read, Chair, unless anyone's got any questions.
What page are you on, Bruce?
So the compliance starts on page 71. Right. Quite frankly, there's nothing there that overly stresses me. It looks like we're basically on top of it. And when I look at water compliance, and this is relevant to, our Three Waters compliance, it's probably relevant, Charlie, to our reporting of performance in our annual report. We are obviously stretched in the operational response to call outs or to service requests, I think would be fair to say. But they are what they are at this stage. Is there anything that, you know, from a ratepayer received service perspective, that we should note at this point? The results are the results, but actually, is that the result we want?
I understand that the reported failures and complaints is not the right word, reports from our ratepayers on fixes that need to be made are coming down, and we will see that in our performance.
That you've seen it over the 3 quarters report here that they have reduced over time. Yeah, okay. But we're still outside where we want to be. Martin?
Yes, just referring on page 71 to the 7 consents that went longer than 20 working days. How does that compare with previous years, please?
Russell, do you have any?
Yeah, through the chair. Thank you, Mayor Martin. We do have some that go over time, but overall, my reflective comment would be that for a small team, we apply our skills with consistency and timeliness. So it's not an anomaly in comparison to last year, but there are some that go over time due to sickness and those factors. But I'll leave you with that overall, that summative comment of generally an timely team.
That might be something you could share with the committee later. Russell, is just really Martin's question was actually how does this compare with last year? So perhaps you can just
factual question. How does that compare with previous years?
Yeah, come back to us on that. It's a matter of a couple of numbers on an email, which would be fine. What, by the way, Russell, the multi-proof consent, sorry. What's a multi-proof consent? You went on me, sorry. Not that I'm a consenting expert by any stretch of the imagination. Do you know?
Yes, so this time last year, so we've got the October report last year. We had total consents was 66. Total granted under 20 days was 66. Average clock days was 13 and 100% were processed under 20 days.
Right, thank you. So it's like deterioration. That's not a big number.
Just for the people concerned.
The service received also for people is not what they want.
What's the difference in numbers? Sorry, just the comparative numbers?
Previous years. There was 0 the previous.
0, right. Yeah.
That means building consent.
Yeah, that was the very top one. Is that
Yeah,
what we're looking at? Yes.
Okay, so let's go back. Thank you for that. Russell or Stephen, what's a multi-proof consent?
Chair, as a loose answer, there'd be those which have several factors involved within it, but I will check that out and come back with a full answer.
Yeah, no hurry, mate. It's probably more of my interest. Okay, thank you for that. We'll take that information.
Before you move on, a multi-proof consent is one that has already been through MB and through the building process and comes to you with some control and specifications around it. So it's easy, it should be easier and quicker to process.
So this is without this is the Genium home or a
not necessarily, no, but it's a pre-approved set of plans and conditions that come to you with MB approval.
Okay, I think it might have been that given the shorter time frame. Thank you for that. Any other questions on the compliance report? It was reasonable performance, don't get me wrong. So that's cool. I'm not too worried. We know improving performance. We'll still have a few not mets in our annual report. We can report on that faithfully. And Stephen, thank you for that. I wonder if we could move then to the big report. That would be great. Thank you.
I'm pleased to present the report on behalf of Maine, who is tied up with another urgent issue in council. There have only been fairly minor changes since the previous report was presented to you. One of those changes is that we've added a graph illustrating the length of service, which you requested. And I believe there was a question around how does the length of service issue for us connect to the knowledge transfer and making sure that we retain institutional knowledge in the organisation. The comment that I would make on that is that if you look at that new graph, shows that we do indeed have a large proportion of our workforce new council, but the average level of experience across the teams shows us that we're still in fairly good shape in terms of ensuring business continuity and that institutional experience is present in our teams. Water being one area where there's an exception to that. And comms also right on the line, but otherwise you'll see that the other areas have got a fairly, they've got a healthy enough average experience level to ensure institutional knowledge is transferred. So that was our attempt to try and answer that question that you asked us last time, and any feedback gratefully received. And then the only other thing is you'll note that the efforts we've been making on trying to reduce leave balances and the costs associated with that has borne some fruit, and you're starting to see the annual leave balance trending down across the organisation. Thank you.
Thank you for that. You say we're getting in a good pattern of reporting here, and thank you, Stephen, indeed, comments sensitivity to where we were at the last meeting. Questions or comments for folk? Yeah, Woody.
That one about outside the box. The gender count constantly seen around the place these days about gender equality of work and whatnot. Why is it that we have such a high base of female staff? Is that generally to the type of work we do, or is it just that councils generally have more females? Or
I think it's a very difficult question to answer, councillor. Obviously, we the market for candidates, and we appoint the most suitable candidate to the role. In our case, we have more females than males, but
I'm fully for this.
the situation is not the men.
Maybe we don't need smart people. Who knows?
You're alleging bias, council.
Well, who knows? Yeah.
I think we should be careful in our conversation, but having said that, I'd be interested to know what the more broader trends are. Woody, to answer your question, I can only speak in an area that Charlie and I work in, which is accountants, but it's been long recognised over the last few years that it's probably been a majority of females entering tertiary training in commerce.
Yep.
For instance, so
particularly in public service.
That's right. You then get a flow through into employment.
Otherwise, blokes aren't really interested.
Well, anecdotally, that would be fair. I've only received one sort of application that I've considered from one male candidate from multiple rounds of things. Yeah.
Interesting.
You can only consider the applicants that are in front of you at the time.
And all I'm doing is reflecting that actually, given the demographics that move through university at this stage around commerce, you're going to have more female applicants.
That would.
Okay. So you do that, Woody. Interesting observation. Any other question or comment would like to make? Follow.
Employee costs are up. And time, etc. How we addressing those are the factors.
And through the chair, employee costs are lower. usually.
Higher in terms of time, et cetera, and contractors.
Which page,
Is that in the financial report, what, Bos?
Yeah, daily financial report.
Yeah.
Obviously,
Yeah, I saw that.
things like holiday pay, et cetera, leave balances being excessive, overtime, and things leads into that. So I've listed that in the financials.
So we're within budget on
Sorry, Joss.
employee costs. Hang on, unless I was.
I think there was a small adjustment up, was there not, Charlie? From the financial report, I have to go back in there.
Now,
Yeah,
Yes, so I'm completely wrong. I realised that their employee costs gone up. At some recruitment and licensed contractors. But
I mean,
mainly adults.
contractors don't come into your personnel cost line, but unless you employ them on a fixed term, they come into your operating cost line. But personnel costs this year, as at the draft, were slightly under the budget. So we have planned those very well, by the looks of it. But yeah.
so.
And don't forget that we do have some roles which are funded from grants and things. So where we have been doing things like local water done well, we've had the funding to pay for those roles that help us with the transition. I have no idea how we would have done the transition and the water services delivery plan without those external roles helping us out.
It's not criticism.
No, yep, cool.
We also something to keep in mind as you head towards next thing. Any other comments or questions on the people?
Very good report. Thank you.
Okay, look, we've gone nearly 2 hours. I'd like to suggest that we take a short break. We're about, well, so halfway. Let's make it 2/3 the way through our meeting, Colin. And can I suggest that we just take our break and can we be back at 11 o'clock, please? If you're great. Thank you.
I get 2 minutes after. I'm just fitting on bed. It closes at 11 o'clock. So.